All right, let's get into it. Today, we are diving deep into the huge debate raging around Netflix. After a pretty rough start to 2026, Wall Street is completely torn, and we're going to break down the clash between the bulls and the bears to see who's really got the winning argument.
So the stock has plunged nearly 18% just this year alone. And when a giant like Netflix drops that hard, that fast, everyone's asking the same big question. So to get to the bottom of this, we're setting up a classic analyst showdown, pitting the bull case directly against the bear case.
On one side, you've got the bulls. They see a company that's fundamentally solid, totally oversold, and just poised for a major comeback. But on the other side, the bears are arguing this isn't just a dip. Nope, this is a totally justified repricing, and the pain might just be getting started. Okay, let's kick things off with round one, the bull case. Now, based on the power of their arguments, analysts are scoring this side of the debate a 3.7 out of 5. So the whole foundation for the bull argument, it's not wishful thinking. No, it's built on rock-solid, hard numbers that show this business is still an absolute powerhouse, no matter what the stock's been doing lately.
Okay, first up, a colossal subscriber base of 325 million people. And get this, that number is not just sitting there. They added an incredible 41 million new members in 2025 alone. That really proves the core business is still firing on all cylinders. And this chart here really drives the point home. This isn't just about adding more users, it's about pure financial muscle. We're talking about a super healthy 27% operating margin. That's how much pure profit they're squeezing out of their sales. On top of that, you've got 16% revenue growth and a whopping 28% jump in earnings per share. I mean, come on, those are not the numbers of a company that's struggling. And looking ahead, the bulls see a super clear runway for more growth. For one, ad revenue is on track to double to $3 billion this year. Then you have the content pipeline. It is absolutely stacked with global mega hits like Stranger Things and Squid Game. And let's not forget, Netflix has proven time and again that they have pricing power. They can raise prices. To top it all off, they've got a $17.1 billion share buyback authorized. That's them using their own cash to buy back stock, which is a classic move to boost the share price. And this is a big one. After that huge drop in the stock, the valuation is starting to look really, really compelling. Its price-to-earnings ratio, which is basically just a way to see if a stock is cheap or expensive, is sitting around 30. For Netflix, that's the lowest it's been in years. The bulls are basically screaming that for a company growing like this, that's a bargain.
But hold on, the bears have a very, very powerful counter-argument. And it actually scores a little bit higher, a 3.9. And their whole case, it's not about what happened in the past. It's all about the uncertainty of what's coming next. And the biggest weapon in their arsenal? This massive $83 billion overhang. I'm talking about the proposed acquisition of Warner Brothers Discovery. This deal, it changes everything. You see, this one deal unleashes a whole storm of risks. You've got the potential for a bidding war, which would be incredibly expensive. You have huge regulatory hurdles. Antitrust scrutiny is almost a given. The financing is super complex. And this is a big one for investors, it forced them to hit pause on those share buybacks. Plus, you got activist investors who are fiercely fighting against it. Okay, and here is where the bears land another huge punch. They're not just making stuff up, they are pointing directly at Netflix's own guidance for 2026, which, frankly, looks pretty weak. Yeah, this is what's so powerful. This isn't some bear case analyst's prediction. This comes straight from the horse's mouth. This chart shows Netflix's own forecast. They're telling the world that revenue growth is slowing down to that 12 to 14% range. That's a big drop, and they're expecting to miss Wall Street's earnings targets for the first quarter. For the market, that is a huge red flag. And it doesn't stop there. You throw in a bunch of other headwinds. The whole streaming market seems to be hitting a saturation point. User engagement across the industry is kind of flat. You've seen some notable insider selling recently, and the cost to make all that great content just keeps going up. Oh, and if you look at the stock chart, it's in a clear downtrend. Yeah, the bear case is looking pretty tough to ignore.
Okay, so we've heard strong arguments from both sides of the ring. Let's head over to the judges' scorecard and see how this all breaks down.
All right, so who takes it? Let's go to our tail of the tape and break this down category by category. And this is a real slugfest. Look, the bulls, they score a perfect 5 out of 5 on historical subscriber growth and that attractive valuation. Can't argue with that.
But the Bears land some knockout blows with that week forward guidance and, the big one, that massive overhang from the Warner Bros. Discovery deal. So, when you tally it all up, when you weigh the impact of every single argument, the Bears just barely squeak out a win. The final score? 3.9 for the Bears, 3.7 for the Bulls.
So there you have it. The verdict is in and the Bears win. For now. That combination of soft guidance coming directly from the company and the huge cloud of risk around the WBD deal just gives them the edge in the current environment.
But, and this is important, this was not a knockout, not by a long shot. The bull case for Netflix's long-term strength and resilience is still incredibly strong. It's just that right now, their entire argument pretty much comes down to a positive outcome for that mega deal. And that really leaves us with one final crucial question. The whole story for Netflix right now boils down to this one single event. So you, as an investor, have to ask yourself, what is the market getting wrong? Is it mispricing the huge downside if this deal blows up? Or is it underestimating the massive upside if they actually pull it off?